Hi, our project's high budget films versus low budget portfolios. I'm Taylor and our other group members are Andy and Nicole. So let's get into it. I want to tell you about the differences between high budget and low budget films and what our belief was. So our belief was that by investing in a portfolio of smaller budget films, an investor would yield a higher net return. Okay. Well, with a high budget film, the production would be able to produce more elaborate scenes with grade A actors. So we're thinking Leonardo DiCaprio, Johnny Depp, lately Dwayne The Rock Johnson. High budget films have a larger film crews, can utilize a plethora of filming locations, and have the ability to take longer to film. Essentially, the money buys you more time. To keep those crews on standby and to hold location, that takes money. So a low budget film would typically need to get their project done within a couple weeks or a month, which can be an asset and a hindrance at the same time. Low budget films rely on great storylines and strong scripts to sell their movie. That is the bulk of what they're trying to sell. They're trying to say, hey, this is the idea, it's great, and listen to what we're saying. The low budgets also have the ability to take more creative risks since they're not putting $70 million on the line and they're working with 5 to 10 million. They're not as under as strict policies where the studios might want to micromanage what they're doing. This is our hypothesis. Our hypothesis was that we wanted to test a portfolio investment and portfolio investments consisting of 4 to 5 low budget films will have a greater net return compared to a single investment in a high budget film. Due to the diversification, the investment in a portfolio should have a lower risk associated with the portfolio. We examined the budgets and profits both domestically and worldwide and compared the values in order to determine expected return. We took into account a couple of independent variables that would also play into overall rate of return. So here's some information on high budgets. The budget threshold is 10 million and above. Most high budget films in the data set range from 100 to 400 million. Nowadays, we do see a lot of films averaging around 70 million. Well-known big budget films, Avengers, Pirates of the Caribbean, Avatar, Titanic, Fast and Furious. Companies that typically produce big budget films would be Walt Disney Studios, Warner Brothers, Lionsgate Films, and so on. So here's some low budget film information. The budget threshold is 10 million and below. Most low budget films in the data set range from 1 to 9 million. Well-known low budget films produced by Blumhouse are Paranormal Activity, Get Out, and Split. 46 Blumhouse films were used to construct the portfolios in our data set. We thought the best theory to apply to our hypothesis would be the theory capital asset pricing model. So, capital asset pricing model, theory that describes that the risk versus reward of an investment and gives the investor a better understanding of expected returns. Specifically, the capital asset pricing model talks about the volatility of singular large initial capital investment versus the diversification of a portfolio investment. There is a sweet spot within the capital market line where there is low risk and a maximum amount of return. Low risk is due to diversification of expected capital compared to more conservative styles of investment. Investors will often chase a higher rate of return and in turn create more risk as they move toward either end of the parabola, demonstrated by the capital asset pricing model graph on the next slide. So we're looking at the capital asset pricing model graph. Any portfolio that is on the capital market line is going to have a better rate of return and have less overall risk than the portfolio that is to the right of the line. The efficient frontier is a sideways parabola that depicts the risk and follows a portfolio investment, and it shows that at the base is a spot with the best risk to expected return. In order for our theory to be proven correct, we should want our results to land somewhere on the capital market line and have a higher return than one from a singular investment. So why portfolios? Start for Blumhouse. Blumhouse is notorious for being successful in low budget film industry. They're kind of the leaders at this right now. They are gold where it comes to low budget films. So much that some of the higher budget film companies have taken notice and they've been trying to work with them and get into their realm and figure them out. But in our research, we wanted to know if it would be more profitable to invest in a portfolio of lower budget films than a single high budget one. Each portfolio was composed of 4 to 5 small budget films. So for an example of low budget films, we have here at the bottom, Split, Get Out, Insidious, Paranormal Activity, The Purge, Anarchy. And fun fact about Paranormal Activity, that went on to make $200 million. Here's our data set for high budget films. Right now, Avengers Endgame is one of the highest budget films produced to date. In our data set, it shows that to produce this film, it cost $400 million. And that's because of the A-list actors and the CGI and the multiple filming locations. And that's what you get and comes out with, you get the results of Avengers Endgame. So for low budget, we have Happy Death Day at the top on our data set at $9 million. And on the bottom, you can see Boy Next Door. Cost $4 million to make, but made a profit of $49,401,000. Here's what we got with our statistics and results. The average of the production budget for high budget films was $218,982,000. The average of the production budget for low budget portfolios was $4,174,000. Over here on the left, you can see the standard deviation and variance for a high budget's net return, the standard deviation of 213. And on the right, you can see the standard deviation and variance for low budget's net return, standard deviation of 8,565.3302. So for our data and calculations, our group uploaded the data set of 100 high budget films and 9 portfolios consisting of 4 to 5 low budget films into our studio. Once uploaded, we generated a regression equation. Our dependent variable, what we were trying to predict, was the net return of investment in a film. The independent variables include production budget, worldwide gross, and a dummy variable. Dummy variable. Big budget films were assigned a value of 1 and small budget films were set as 0. This allows us to see if films will have a greater return simply for being high or low budget, since the intercept in the regression will change. And here's our regression equations. Take a minute to look at those. You can see our standard equation, our equation when dummy equals 0, and equation when dummy equals 1. Here are regression results. We included our standard equation as well as what the new equations would be when the values of the dummy variables are factored in. Notice the intercept change. Regression results. The coefficients that had a negative effect on the model were production budget and dummy. The coefficient that had a positive value was worldwide gross. The intercept for the regression was 3,235. This means that if all values tested in the regression were set to 0, the average net return would be 3,235%. Our scatter plot graph was generated in RStudio, showing the relationship between all films production budget and their worldwide gross. So what was our conclusion? Well, initially we thought that investing in a portfolio of smaller budget films will yield a higher net return than a single high budget film. Since many of the Blumhouse films were used in our data performed extremely well. However, it is evident that the films with budgets over 200 million in our data set also performed very well. In the end, our calculations suggest that the variance of the return was higher in low budget films than in high budget films. It appears that our initial hypothesis was incorrect and implies that a higher budget films tend to yield returns more consistently with less of a variance in their profits. That was our project. Thank you for taking the time to watch and listen. Hopefully you got a few things out of it, and we appreciate your time.